everyone, and welcome to our yet another very exciting lecture on the cost of capital. Now, this lecture, of course, opens the discussion on cost of capital and forms our lecture number 1 in this unit, cost of capital. So what are we going to talk about here? We shall, of course, begin with a key definition of cost of capital. We want to understand what is cost of capital, and then we shall look at the aspects of cost of capital. Then we shall go into the cost of capital as an opportunity cost. We shall look at the cost of capital and risk. Then we shall look at the relative costs of sources of finance. Then we shall look at the creditor hierarchy under this unit. So, of course, to kickstart our discussion, we begin with the key definition. Okay, we move into the key definition, and of course, we are asking ourselves, what is the cost of capital? What is the cost of capital? So, we continue in this bullet by saying that the cost of capital, we are saying that the cost of capital is the rate of return that the enterprise must pay to satisfy the providers of funds, and it reflects the riskiness of providing those funds. So, of course, all entities need capital. They need funds to finance their various operations or to finance their capital investments. So, of course, these funds will come from different sources, and behind those different sources, there are providers. There are people who have maybe saved this money. There are people who have made this money, okay, and they are ready to give you these funds. So the people who are behind those different sources of finance you are employing in your company will need a rate, okay, will need a compensation for using their money. Of course, we shall see how this rate is determined. But these people that are providing you the funds will need a certain return, okay, the certain return. They charge a rate on which they determine the return on their funds, and of course you have to pay that rate or that return for you to satisfy, okay, for you to satisfy those providers on funds. And of course, if you pay them their return, they are still willing to let you use those funds, okay, employ those funds in your company, or they are willing to even add you more money to use in your enterprise. So it is a very important return that must be paid by an enterprise to satisfy those that provide funds. And of course, as we have mentioned in our definition, that the rate they charge reflects how risky you are, okay. Are you a person who is going to pay immediately, okay? In our future discussions, you see that providers of finances need money and need back their money as soon as possible. So as they are determining this rate of return, the riskiness of providing these funds is put into perspective and incorporated in what we call the cost of capital. So this should give you a very clear background and definition on what cost of capital is all about. And of course, when I look at this, I see two major words. I see the word cost, okay. What is a cost? That is an expenditure. And then I see another word called capital. So these two make up the cost of capital. So briefly, or in plain language, we shall say cost of capital is the expenditure that you are going to incur on capital, okay, expenditure or the cost you're going to incur on the capital you are using or you are about to use in your enterprise. So on the second slide, we move into aspects of cost of capital, okay, we move into aspects of cost of capital. And of course, in the slide we are saying the cost of capital has two major aspects to it. The cost of capital has two major aspects to it. As I've mentioned, the expenditure, okay, you are going to incur, or the cost of the funds you're using, you're going to raise and use, the business, and then number two, the issue of a return. Okay, so in the process of looking and raising these funds, you're going to incur some expenditure. Okay, you're going to incur some expenditure. And of course, the funds won't just come on a silver platter. You need to look for this money. You need to really sweat and look for this money. So the sweat you're going through, the efforts you're making, the expenses you're paying will form part of the cost of those funds that you're raising and you're going to use in your company. And then on top of that, doesn't stop at the expenditure you incur in searching for the funds, but it also goes into the return you must pay to the investors. As you are saying here, investors expect a return to be paid for putting their funds into your company. So we continue on the next bullet by saying that it is therefore, the cost of capital is therefore the minimum return the company should make on its own investments to earn the cash flows out of which investors can be paid their return. So you will continue with the aspects of cost of capital on the following slide by saying that the cost of capital can therefore be measured by studying the returns required by investors. The cost of capital can therefore be measured by studying carefully the returns required by the investors. And of course, here we continue by saying that the cost of capital can then be used to derive the discount rate for discounted cash flow analysis. This one here, the DCF, discounted cash flow analysis, and investment appraisal. So by the look of things here, we are saying that we are not going to invest funds in investments or projects that are not going to return this minimum rate that the investors or providers of funds require. So the cost of capital is a very, very key aspect of investment appraisal. When you are appraising projects, we use this rate because that's what the providers of finances want. So in the following bullet, we continue by saying that each form of capital has its own cost. Okay, each form of capital. In our previous discussions, you have seen the different forms of capital. You can use debt, you can use equity, and so on and so forth. So we are saying that, for example, equity has a cost, and each bank loan or bond issued has a different cost. Therefore, a company must make sufficient returns from its investments to satisfy the requirements for return of all the different finance providers. So you must make a return. As I've mentioned, you must ensure that your projects are profitable so that you can pay the providers of equity capital, providers of debt capital, providers of preference share capital, and so on and so forth. So we continue to appreciate the fact that the cost of capital is actually an opportunity cost. Cost of capital is an opportunity cost. And here we are saying cost of capital is an opportunity cost of finance because it is the minimum return that investors require. So of course, from our previous discussion, we have seen that in the concept of opportunity costs, and of course, we've appreciated that opportunity cost is the benefit foregone from selecting the next best alternative. The cost of capital being an opportunity cost of finance, in this case, means that investors select your business or your project to employ their funds, and therefore they will forego other benefits which would be derived from employing their funds into other projects that may be similar or may pay a similar return like yours. So you continue by saying that if they do not get this return, therefore, they will transfer some or all of their investment somewhere else. Remember, as I've mentioned, you are not the only one running an enterprise. There are other people running other enterprises and who also require funding. So if you do not pay the investors their return, then they are likely to shift their funds to another enterprise. And of course, here we are looking at the opportunity cost of capital in two ways or in two dimensions. For example, if a bank offers to lend money to a company, the interest rate it charges is the yield that the bank wants to receive from investing in that company, because it can get just as good a return from lending the money to someone else. In other words, the interest rate is the opportunity cost of lending in the case of the bank. So in simple terms, you're saying that the bank has very many applications or submissions that have been made for people who want funding. So the bank giving you money, it means that you must pay the interest, okay, the interest on the loan, and this interest on the loan represents the opportunity cost of lending your enterprise by the bank. So it means that if you do not pay, or if you're not willing to pay this interest rate, then they will move to the next applicant, the person who wants funding just the way you want from the bank. Two, we are looking at the case when shareholders invest in a company. The returns that they can expect must be sufficient to persuade them not to sell some or all of their shares and invest the money somewhere else. Okay, so you should promise them that return. You should be in position to pay that return so that they are persuaded not to sell all or some of their shares and invest somewhere else. So you continue by saying that the yield on the shares is therefore the opportunity cost to the shareholders of not investing somewhere else. So here we appreciate the fact that the cost of capital is indeed an opportunity cost, okay, because it is the benefit foregone by the investors from not investing in other sources that are just as good as your enterprise. So we move into the cost of capital and risk, and of course in all the other discussions we've had, we've mentioned that cost of capital moves hand in hand with the aspect of risk. So in our next discussion, we talk about the cost of capital and risk. And of course, here we are saying that the cost of capital can be analyzed into three elements. Okay, the cost of capital can be analyzed into three elements. And number one is now what we call the risk-free rate of return. Okay, these are the elements of cost of capital. We have the risk-free rate of return. And then number two, we have the premium for business risk. And then number three, we have the premium for financial risk. So in total, this gives us what we call the cost of capital. So in simple terms, I may say cost of capital comprises of the risk-free rate, the premium for business risk, and the premium you pay for financial risk. So we want to understand what are all these about. So in the next slide, we move into the risk-free rate. And here we are saying the risk-free rate is the return which would be required from an investment if it was completely free from risk. So of course, there are those investments that we perceive are risk-free, and here we are saying typically a risk-free yield on government securities would represent an investment that is free from risk. Of course, ideally or globally, I would say all investments have a component of risk, but of course, government securities have been perceived for a very, very long time to be risk-free. So the risk-free rate is what you get from investing in a project that we perceive is free from risk. So ideally, an investor will not allow a return that is below a return from this risk-free security. An investor will not allow a return that is below the risk-free rate of return. So the investor will require something just above the risk-free rate, because ideally, why would they invest? Because ideally, why would they invest in your risk business and leave the risk-free security or project? So you must promise the investor that, you know what, I'm going to pay to you something that is above the risk-free rate. So next we have what we have mentioned, the component or element of cost of capital, which is the premium for business risk. And here we are saying that this is an increase in the required rate of return due to the existence of uncertainty about the future and about the firm's business prospects. And of course, from your projections, you may show a very, very nice picture that I'm going to make these profits in the future using your money, but you know that uncertainty, the future is always uncertain and filled with a lot of risk. So the fact is that you may not achieve what you have promised. So that presents what we call a business risk for the person that is investing in your company. So you are exposing this person that has invested in your company, you are exposing them to the business risk that is inherent in your business. And from our previous discussion, we have mentioned that business risk is actually the fact that the profits before interest and tax that have been derived are actually different from the projected or anticipated profits before interest and tax. So we continue by saying that the actual returns from an investment may not be as high as they are expected to be. As I've mentioned there, business risk will be higher for some of the firms than others, and some types of projects undertaken by a firm may be more risky than other types of projects that it undertakes. So this again emphasizes the fact that the premium for business risk that you pay is not a blanket rate. It's not a blanket rate. It is going to be specific to your business. It's going to be specific to your project. Reason being that different projects have different business risks, and of course, different entities or environments or industries have different business risks. So that's why you will see that the rates or the premiums required by funders for business risk are going to vary depending on the business that you are engaged in, or depending on the industry in which you are of course operating. And of course, in our previous discussion, again, we mentioned that business risk will also come in with the fact that you may lose your competitive edge. Okay, you may cease to be competitive because, as I've mentioned, the future is very, very uncertain. There may be other entrants to the market, and therefore these people may eat into your profit. Okay, they may eat into your profit before interest and tax, and therefore you find that you have not achieved the promises you made to the funders, the promises that you made to the funders, and therefore they require to be compensated for the inherent business risk. Finally, in the next slide, we talk about the premium for financial risk. We talk about the premium for financial risk, and here we're saying the premium for financial risk relates to the danger of high debt levels, what we are calling here high gearing. And of course, from our previous discussions, we've mentioned that gearing is the situation where you finance your operations using debt. So gearing comes in with debt. Of course, we've mentioned that gearing is the amount of debt in your capital structure. So if you are highly geared, it means that you have a lot of debt in your capital structure. And therefore, if you are to request for funds, or if you are to apply for funding, you have to pay a premium for financial risks. You have to pay a premium for financial risk for all that debt that is within your capital structure. And of course, here we are continuing by saying that the higher the gearing of the company's capital structure, the greater will be the financial risk to ordinary shareholders, and this should be reflected in a higher risk premium and therefore higher cost of capital. And of course, if you look at the cost of capital and see the cost of capital is extremely high, then this could be one of the reasons. The reasons could be that the company is highly geared, it has a lot of debt in its capital structure, and therefore the providers of finances, the ordinary shareholders, have requested for a high premium for financial risk. All right, so those are the three elements that we have seen that comprise of our cost of capital. So we move into the next discussion, which presents the relative cost of sources of finance, And of course, from our foregoing discussion, we have mentioned that different sources of finance have different costs of capital. So we want to see which one will give you a high, cost of capital, and which one is going to come with a minimum or low cost of capital. So we continue in the slide by saying that the cost of debt, the rate a firm pays on its current loans, bonds, and other debts is likely to be lower than the cost of equity. The cost of debt is likely to be lower than the cost of equity. And in brackets, we are saying that the return paid to shareholders, that's the cost of equity, is going to be higher than the return paid on your current loans, bonds, and other debt forms of debt. Now, of course, this brings into a perspective the fact that debt capital has a low cost as compared to equity capital. Debt capital has a low cost as compared to equity capital. And of course, the reasons we are giving here is that this is because debt is less risky from the debt holder's point of view, okay? In the event of liquidation, the creditor hierarchy dictates the priority of claims, and debt finance is paid off before equity. So it means that you are safe if you have decided to provide funds through debt, okay? Because the creditor hierarchy in most legislations or in most jurisdictions dictate that debt holders should be given a priority over the equity holders, okay? So it means that debt is less risky as compared to equity. This therefore makes debt a safe investment than equity, and hence debt investors demand a lower rate of return than equity investors. And of course, you all know in most jurisdictions or in most financial institutions or providers of funds, in most cases, if they are to give you debt, then you must secure this debt. In case of failure, then the security can be liquidated to try and salvage the situation, or to try and pay off the debt that has been acquired from the debt holders. On the following slide, I will continue in our discussion by saying that debt interest is also corporation tax deductible, which is not the case of equity dividends. So whenever interest is paid to the debt holders, the tax authorities will allow, or the government will allow a deduction for tax purposes, and therefore making it even cheaper to a tax-paying company. So a tax-paying company will enjoy this deduction, and therefore debt becomes really attractive and very cheap, okay? Really attractive and very cheap. So we continue by saying that arrangement costs are usually lower on debt finance than on equity finance. And once again, unlike equity arrangement costs, they are tax deductible, okay? Even the debt issue costs, the cost that you incur in acquiring debt are also tax deductible, okay? The cost that you incur on sourcing for debt are tax deductible. Therefore, it makes it very attractive and a safe source of finance as compared to equity. So, of course, we all know equity is a very expensive source of finance in terms of the issue costs, the cost of sourcing for equity, and at the same time, the dividends you pay to equity shareholders are not tax deductible for tax purposes. So that again points to the fact that most countries really appreciate it, especially those that are developing, appreciate debt as a source of finance, because debt is a cheap source of finance. So this, of course, opens our discussion on the creditor or payables hierarchy, okay? And of course, we are going to present our hierarchy in an increasing order, okay? In the order of increasing risk. So I'm going to move from rank 1 to the last rank, looking at the different sources of capital and their perceived risk as compared to others. Of course, if my increasing risk is coming from number 1 going down to the last source I'm going to present. We shall have in number 1 creditors with a fixed charge. Okay, now creditors with a fixed charge will charge a lower cost of capital, and the reason is that they have been secured. Okay, they have been secured, and not only a security that is not specific, they are secured with a fixed charge. They have a fixed collateral. So therefore, all the risks have been insured. Okay, all the risks have been insured and safeguarded. The creditors are safeguarded from any possibility of loss. So these creditors are in rank number 1. You would run to these ones because they're not going to charge you a lot in terms of cost and return, because they need security to safeguard their interests. In number 2, we have creditors with a floating charge. Again, these ones are going to charge a relatively lower, cost of capital, okay, or a relatively lower cost and return on their investment or on their funds, because again, as I've mentioned, they have been secured, though their security is a floating one. Okay, is a floating one, a bit more risky than a fixed charge. A person with a fixed charge knows that this property or this asset has been given to me, has been pledged, that in case there's failure to return back my money, I am going to liquidate it. Now, for the case of a floating charge, there is no fixed charge per se, but the charge is floating, though again we are saying there is an element of security, and therefore all your worries have been insured. Number 3, we have unsecured creditors. These ones come in rank number 3, the unsecured creditors. Now, these ones will charge a relatively higher rate or cost of capital as compared to the creditors with the floating charge and creditors with the fixed charge. Reason being that they do not have a well spelled out or identified security. There is no security or asset that has been pledged to safeguard, of course, their return and interest in the investment, or to safeguard their funds in case of failure to pay back. So they will charge a relatively higher cost of capital for that matter. And of course, in rank number 4, we bring in the preference shareholders. As you know, these shareholders are not secured in any way besides a promise to pay a fixed dividend. We know from our discussion that preference shareholders are those that have been promised a fixed dividend, okay, but there is no security per se, so they will tend to charge a higher rate as compared to the creditors in rank number 1, 2, and 3. In number 5, we find these other guys, the ordinary shareholders, who will charge you a very, very huge rate of return. And the cost of sourcing for these funds is again going to be so high. Reason being that these are the people that are considered last in case the company goes into liquidation or insolvency. So their interests are not safeguarded in any way, and that's why in most cases, and that's why they are usually made part of the owners of the company. So they're taken as owners of the company, and they will suffer losses, huge losses in case of insolvency, and they are considered last during liquidation. So they are likely to charge a very high cost of capital as compared to all the other categories in rank 1, 2, 3, and 4. So this is our hierarchy that should, of course, guide you on how to identify the nature of the cost and the nature of the return that is going to be required from the various providers of finances. So we move to our very, very last discussion, okay, which is the cost of equity. Now, the cost of equity is contained in the next video, next lecture. So I want you to go to your accounts and try to move now to this lecture that takes you through determination of the cost of equity, we shall see what is the cost of equity all about. We are going to, of course, look at the different approaches of determining the cost of equity. So for now, we shall end our lecture at this point.